Here he is.
Hey, Bob.
You've come back.
Yep, I have. And good news, the Wi-Fi is back on.
Trying to figure out why I have this alarm. What's today? Tuesday?
Yeah, today's Tuesday.
Tuesday. So I don't do any tutoring today. Okay. All right. Let me move over to the normal spot here. All right. Okay. Just give me a moment to get organized here. Okay. All right. We just tested on chapters 1 to 4. So we're up to chapter 5, huh? Let me get these organized. Okay. Hi, Michal. Hi, Hunter.
Hi, how are you?
All right. Share screen. Chapter 5. Come on. Okay, let's see what we have here. Chapter 5. They're going to be talking about this longer income statement, huh? So let's see what we have here. Let me do this. Wow, look at all this. Okay. Merchandising operations, inventory systems. Okay. We know about the wholesaler, retailer, consumer line, right? The wholesaler buys from the factory in big quantities, ships big quantities to the stores, and the stores sell to the end user. That's us. We're now going to see a longer income statement. This income statement is going to start with sales, subtracting cost of goods sold to get something called gross profit, and then subtract operating expenses to get net income. Cost of goods sold is the total cost of the merchandise sold during the period. Operating cycles, the flow of the costs. We have a beginning inventory, right? And purchases. You take the beginning inventory plus your purchases, that gives you the total cost of goods available. That's the most you could have sold. You had 100 books in your store at the beginning. You brought in another 900 books. That's 1,000 books available for sale. At the end of the month, you either sold them or you still have them in the inventory. And we have to use these two systems to put the cost into the proper bucket, whether in the inventory or in the cost of goods sold. A perpetual inventory system. It maintains detailed records of the cost of each inventory purchase and sale. It maintains inventory records so that inventory that should be on hand is constantly updated, and it determines the cost of goods sold each time a sale occurs. With a perpetual system, you know, perpetual means forever. You know always how much inventory is in your warehouse. Someone says, do you have these 8 televisions? You just click on a button and your computer will tell you how many you have. Look at this formula here now. Here's an important template, okay? Beginning inventory plus net purchases equals goods available for sale. We physically count what's there at the end of the month. We actually count, and we had 125,000 left, meaning our cost of goods sold was 775,000. This type of thinking must be done under what's called a periodic system, where you don't have You don't have perpetual records. The perpetual system is the best by far. It's traditionally used by merchandise with high unit sales, shows quantity and cost at all times, better control. Perpetual system, every time you sell something, you're recording the sale and the cost of goods sold. Indicate whether the following statements are true or false. Let's see what we have here. The primary source for merchandising is not from performing services, it's from selling your product. The operating cycle of a service company is usually shorter than that of a merchandising company. I don't care about that. Sales revenue less cost of goods sold equals gross profit. Absolutely true. Very important. Ending inventory plus the cost of goods purchased absolutely equals the cost of goods. What? Ending inventory plus cost of goods. Ending inventory. Oh, yeah, my bad. Ending inventory plus cost of goods sold equals goods available for sale. Read that too quickly. The key concept here is sales revenue less cost of goods sold equals gross profit. Record purchases under a perpetual system. Under a perpetual system. Well, there's an invoice. We know what an invoice, I think, looks like. And they're saying that they use a purchase invoice. Well, under the perpetual system, look what we're doing. We debit inventory, right? We debit inventory and we credit accounts payable. Inventory is an asset, so it goes up with a debit. Accounts payable is a liability increased with a credit. FOB shipping points. These are kind of interesting and important. FOB, freight on board. FOB represents the exact moment in time when ownership of the goods changes from the seller to the buyer. And this can be very, very important in certain circumstances. FOB shipping point. It means that as soon as the truck leaves the shipper, the buyer owns it and is responsible for all the freight costs. FOB destination, the buyer does not own it until it arrives at the destination of the buyer. And the seller is responsible for paying all the freight costs, all the insurance costs. Assume upon delivery of goods, SOC paid freight for freight charges. The entry on SOC's books. We debit inventory, we credit cash for the freight charges. You notice that, Teddy? We're debiting inventory even though it's a freight charge. Freight is considered part of the inventory cost. If the freight terms had required P8W to pay the freight charges, the entry would have been to freight out. That's freight out is a selling expense, not an internal purchase of inventory. Purchase returns and allowances. Purchaser may return goods because they're not happy with the product or it's something that they didn't want or whatever. Purchase returns. Return goods for credit. Purchase allowance. The company gives us maybe a price break on it if the seller will grant a reduction of the price. Let's look at how to record a purchase return and allowance. Assume SOC Stereo returned goods costing $300. They would have the following. They would debit accounts payable and they would credit purchase returns and allowances. Although but we're in a perpetual inventory system. In a perpetual inventory system, you credit the inventory. We return some goods, we debit accounts payable. We're either going to credit inventory if it's perpetual or purchase returns and allowances if it's a periodic system. I think we want to concentrate more on the perpetual because that's the most normal one in the business world. In a perpetual inventory system, a return of defective invoices is recorded by crediting, and we just said it was inventory. If this said in a periodic inventory system, we would have credited purchase allowance. And you'll get familiar with this as you do the homework. Okay, a lot of this I'm sure is just bouncing off your skull right now. Just getting you warmed up. Credit terms may prompt buyer to claim a cash discount for prompt payment. You see, sellers will sometimes offer what's called a sales discount to customers to encourage early payment. You see where it says on the bottom example, credit terms may read 210 net 30. That's how you read that, 210 net 30. It means that if the customer pays within 10 days, they get a 2% discount. Otherwise, they pay the net, the full amount in 30 days. 2% discount if paid in 10 days. Otherwise, you pay the net amount in 30 days, okay? 210 net 30. It's a very common expression in the business world. And you got 210 net 30. They're explaining it again. 2% discount if paid within 10 days. Otherwise, net amount is due within 30. You could have 1% 10 end of month, net 10 end of month. So all kinds of different ones. 210 net 30, 110 net 30 are the most prominent. Now, SOC is going to pay the balance due. They owed 35, they owed 3,800. And remember, they returned 300 just now. So they owe 3,500. But they're entitled to a 2% discount because they paid it within 10 days. So we are going to debit accounts payable for the entire 3,500. They're going to have a credit of 2% of that, or $70 for a purchase discount, which they call inventory. In a perpetual system, you never use the word purchases. Purchases is substituted by the word inventory, and the balance, of course, would be cash. Okay? So you pay something, you have a discount coming to you. That's what it looks like. You settled a bill for $3,500 with just $3,430. Difference of $70 is the purchase discount, which we call inventory. If they fail to take the discount, well, they have to pay the whole amount. They would have to pay the whole amount, $3,500. And here's another Wiley slide that's all screwed up. This should be $3,500. Should be $3,500 in cash, $3,500. So it's just another of the many Wiley screw ups. I like to put this on the test. Should you take a 2% discount? The answer is absolutely yes, because that equals about 37% a year. Think about it. You're giving up your money for 20 days, right? When you pay 10 days early on a 30-day terms. So you're earning 2% in just 20 days. That means you're earning 2% every 20 days. You divide 20 days into a year, 365 days, you get about 18 and a half. 18 and a half by 2, that's 36 plus. So yeah, a 2% discount is very, very significant. And in these days of very low interest rates, you'd be nuts not to take it. Summary of purchasing transactions, okay? See the inventory here? We had a beginning balance, it looks like, of 3,800 they brought in with a purchase. Then on May 6th, they paid the freight on top of that. So that went up. And then going down, 300 for the return, 70 for the discount, okay? De La Hoya buys merchandise on account. Purchase price is 1,500, and they returned 200. Record the transaction, okay? Well, first we have the purchase, and now they're returning 200. So we're going to debit accounts payable, and I'm assuming we're still in a world of perpetual. We're going to debit inventory, okay? Make a little bit of sense, Teddy? We're buying it, we debit inventory, we credit accounts payable, and now we're returning $200. So we don't owe them $1,500 anymore. We just owe them $1,300. So
Yeah, it
we're
makes sense.
yeah, debiting AP, crediting inventory. Record sales under a perpetual system. We just talked about purchases under a perpetual system. Record sales under a perpetual system. Sales could be for credit or cash, and it's recorded when the performance obligation is satisfied. And that was a question we had on our recent test. Is an invoice. Record the revenue, record the cost of goods sold. This is the main kicker now with the perpetual system. When you sell something under a perpetual system, you'll have the same entry as a periodic. You will debit accounts receivable and you will credit sales for the sales amount. but you will also record the cost of goods sold. You're going to debit cost of goods sold for the cost of the goods and credit inventory for the cost of the goods. In other words, you sold something for, say, $1,000. You debit accounts receivable for 1,000, credit sales for 1,000. You returned 200 of it. We're good, and the cost of it was 200. We're going to debit the cost of goods sold for 200. The inventory credited for the 200. Recording sales on account. Well, we know how to do that already, huh? We record the sales and the cost of goods sold. So what's the key thing with the perpetual system? You're recording both the sale and the cost of goods sold in the selling journal entry. Periodic does not touch the cost of goods sold. That's why we have to count an inventory at month end. Sales returns. Sales returns. These are contra sales accounts now, contra revenue accounts. Just like the contras before were contra purchase accounts. We never debit sales. Never debit sales, never. So when you're doing multiple choice questions and you see one of the choices includes debiting sales, you know it's wrong. What do we debit? We debit the sales contra accounts, sales returns and allowances, and sales discounts. So prepare the entry for PW Audio Supply. PW Auto Supply would make to record the credit for returned goods that had a 300 selling. Okay, so we're returning something. We are getting something returned to us rather. Okay, so we are going to debit sales returns and allowances and credit AR for $300. But we also have to put back the inventory back into the goods were not defective. So we can put at least we can put the $140 back in the inventory and credit cost of sales to reduce that. If they were defective and said they're only worth $50, well, we put it in for $50, that's all. The cost of goods sold is determined and recorded each time a sale occurs in perpetual system only. Perpetual. Understand those two words and what they mean in terms of inventory control. Sales discounts and sales returns and allowances are contra sales accounts. You never debit sales, never. What you debit are the contras to get the net sales down. 3,800 minus 370 is 3,430 net sales. Recording sales discount. Now SOC paid the balance due of $3,500. PW Auto would have the following transaction. They're going to debit cash for $3,500 minus $70 and credit accounts receivable. Stereo paid the balance due of $3,500. They had $3,800 at the beginning. Then we know they returned $300. When they paid the bill, they paid it within 10 days. So they're entitled to the 2% discount. De La Hoya buys merchandise from Junot Diaz. The selling price was $1,500 and the cost was $800. And De La Hoya returned goods with a selling price of $200 and a fair value and a cost of $50. Fair value is a crummy term. The cost of $50. So let's see, we sold it for $1,500. Now, how much are they returning? $200, right? The cost of goods sold was, the cost was $800. I'm sorry, the cost was $800. And then De La Hoya returned goods with a selling price of $200 and a fair value of $30. What they're saying is the $200 sales gets reversed, but the inventory has less value because they might have had something wrong with it. It might have had a chip in it or miscolored, and we can still sell it, but at a discount. Let's look at our longer income statement here. What we've done so far with income statements is we've had sales minus expenses, okay? And that's called the single step format, simple and easy to read. And here it is. This is what we've done so far. net sales, and then we line up all of our expenses, including cost of goods sold. That's going to change now. We're now going to have to worry about gross profit, net income from operations, and net income, bottom line. So let's see what we're talking about. Look what we have here. We have net sales. We have sales, less sales returns and allowances, less sales discounts gives us net sales. We subtract cost of goods sold from that to get the gross profit. And then we subtract our operating expenses, add them up and get a total, subtract that, and that gives us our net income from operations. Then you have non-operational type expenses like interest and taxes, things like that. And that brings us down to a net income before taxes of 31.6. So this is your new template. Sales minus cost of goods sold equals what's called gross profit. And then when we subtract the operating expenses, we get the net income from operations. Here, they're showing you the gross profit and the operating expenses. Then the non-operating expenses. Non-operating would be things like dividend revenue, interest revenue, rent revenue, gain from the sale of property, things like that. Things that have nothing to do with the core intent of the business. Multi-step. It's called multi-step because you have these steps. Step 1, net sales. Step 2, gross profit. Step 3, income from operations. Step 4, net income before taxes, and then net income after taxes. Those are your steps. The multi-step income statement for a merchant shows each of the following except what? It doesn't show the investing section. Okay. Comprehensive. I'm going to skip this for a second. Here they're asking us to prepare a multi-step income statement and comprehensive income statement for Art Center Company. They have a tax rate of 25%. So let's see what we have here. What are our steps? Our first step is to get the gross profit. Sales minus cost of goods sold gives us the gross profit. Then we subtract 187,000 for operating expenses. I notice we have sales discounts, so we have to actually start sales minus sales discounts to get net sales, and the other comprehensive income we'll put at the top. So let's just take a peek. Sales minus sales discount equals net sales, step 1. Step 2, subtract cost of goods sold. Step 3, subtract operating expenses to get net income from operations. And then we have other expenses, revenues, and we subtract out, and there's our income before income taxes. 25% rate equals 28,250. So I would have this printed out, if you can do that at home, and have it in front of you when you're doing your homework, and a very important template to understand, okay? Determine cost of goods sold. Now we're going back to periodic. I'm thinking of skipping periodic. Well, let's go through it. Let's go through it. Determine cost of goods sold under periodic. Now, this is the old-fashioned system when we don't have the perpetual, so we never know what's out in our warehouse without looking. Keep an eye on this template right here. It's the one we showed earlier. Beginning inventory plus cost of goods purchased equals what's available for sale. When we subtract the inventory, that gives us the cost of goods sold. So let's take a look at our cost of goods sold section, huh? Man, before cost of goods sold was just one number, they gave it to us. Now we really have to figure it out. We have to take the beginning inventory plus the purchases and freight to get the total available. We subtract the ending inventory, that gives us the cost of goods sold. Cost of goods sold, another important template to have available. Compute the cost of goods purchased and the cost of goods sold from this, okay? Well, let's do the cost of goods purchased. That would be purchases 162,500 minus 3,400 for purchase discounts minus 5,200 for purchase returns and allowances. That gives us net purchases, but then we have to add the freight in on top of that. So there you have, you have it right there. You had a beginning inventory of $18,000. You add your purchases. And there you go, goods available for sale. They gave us an ending inventory of 20. That means the cost of goods sold was 158. Gross profit rates and profit margin. Here's a couple of metrics. We can always express our metrics in terms of a percentage, okay? By dividing the gross profit by the net sales. So just take a peek at this. Two sporting goods stores. You take the gross profit divided by the net sales, that gives you a number. The higher, the better. So REI in 2016 has a 42.9%. Let's call it 43%. It means that for every dollar they sell, they retain 43 cents. So every time they sell something, they retain 43 cents on the gross profit. Then we would subtract the operating expenses from that, okay? And you can do the same thing with the net profit. Net income divided by net sales gives you net income profit margin, net profit margin. So here, REI, after all expenses and other are considered, they bring home $1.50 for every $100 they sell. Okay, they bring home $1.50 for every $100 they sell. So it's a fairly small margin. And their competitor Dick's is twice as big, but 3.6 doesn't seem too big to me either. So that might be the type of industry it is, low margins. Maybe they have a lot of turnover of inventory to make up for that. Determine the gross profit rate. Well, this is pretty easy. 80, net sales were 80 in 2022, minus 40. That gives you gross profit of 40. So that'd be 50%. 120 minus 60, so they're both 50%. Not too tough. Determine the profit margin. Well, what was the net income? 18,000. What's the formula? 18,000 divided by net sales, 80. 22.5. And then for the next year, it's 20,000 over 120,000 be 16%. Okay, so those are two measurements to be able to compute. Record purchases and sales under a periodic. So now we're back to a periodic system. And this will be confusing for a while, periodic versus perpetual. So 1 second here. Recording merchandise transactions. They're recorded when the goods are sold. PW records the sale of 3,800 on account. The merchandise costs 2,400. Notice what happens now. We're only going to see the purchase of the 3,800. You notice they did nothing with the 2,400 cost of goods sold. That's because we're in a periodic system and we don't record that. We don't do it until the end of the month or the end of the year. And then if there's freight in, we debit freight. SOC returned $300. Remember before we said that when things were returned in the perpetual system, we credited inventory? Here, we're crediting purchase returns and allowances. One way to keep the difference in mind, everybody, is under the periodic system, everything is a purchase. And when you see the word purchase, change it to inventory. Just the one word inventory on the perpetual side. So now we're paying the bill, getting a 2% discount. Debit accounts payable, we get $70 off, pay it with cash. Went over that earlier. Audio records the sale of 3,800 for to Salk Radio. Simple. Accounts receivable, sales revenue, and you notice there is no entry recorded for cost of goods sold under a periodic system to record the return of the goods. The $300 sales return, we're going to debit sales returns and allowance and credit accounts receivable. Okay. PW Auto receives payment of $3,430. Well, this company owed us $3,500, but they paid it in time, so they get that famous 2% $70 discount. So follow these journal entries. They're not too tough. Just get the feel of what we're doing. If you're still shaky on your debits and credits, you just got to keep working on that, okay? So we credit accounts receivable for the whole 3,500, and the cash is 3,430 because they're entitled to that $70 discount. The sales discounts and sales returns and allowances are contra sales accounts, contra revenue accounts. This is a very important screen right here. This explains the differences between the perpetual system and the periodic system. Notice that we're on the periodic system. You see the word purchases, you change it to inventory. You see freight in, you change it to inventory. You see purchase returns allowances, you change it to inventory. Same thing with purchase discounts, you change it to inventory. Otherwise, everything is pretty much the same, okay? In the periodic, we're debiting purchases. In the perpetual, we're debiting inventory. Adjusting entries for credit sales with returns and allowances. Rainbow sold 100 pairs of shoes for $100 each on account to Tanner, and then Tanner returned $60 worth. They can allows them to return anything. The cost of the product was $60. Under periodic, no. I guess they took us back into a perpetual system. Adjusting entries. I'm not sure we want to go over this, but let's look at it. Rainbow sold 100 pairs of shoes for $100 each. So debit accounts receivable, credit sales. The cost was $6,000. Debit cost of goods sold. Credit inventory. Notice we're back in the perpetual world now. Tanner returned 2 shoes with the price of 100 each and a cost of 60. They were the wrong color. So that's $200, 120. Sales returns and allowances. You never debit sales. Never debit sales. You do debit sales returns and allowances and sales discounts. The inventory comes back to us. We get the debit inventory and credit COGS, cost of goods sold. Rainbow prepares monthly financial statements and estimates. I'm not going to go over this for a reason, excuse me. Oh, pardon me, everybody. This is, well, let me just go over it just in case it comes up on the homework. I don't think this is going to be on your test. But companies have to estimate what they think is going to be returned. So they're estimating it's likely one more pair of shoes will be returned. So they're guessing. They're saying we're going to debit sales returns and allowances right now, even though we don't know who's going to return the shoe. And they set up an account called allowance for sales returns. And then when somebody does return a shoe, they put it into estimated inventory returns. Yeah, let's not worry about that. They had the same thing in the McGraw-Hill book, and the faculty as a group said we're not going to worry about that. Not going to worry about the lands. So that's pretty much the end of the chapter. You know, we don't go into IFRS really at all, okay? Anybody have any questions or anybody? I know we went through it fairly quickly. It's really not a whole lot, this chapter. It's pretty finite. what do you have? You have the new income statement, the longer income statement, and you have the two worlds, periodic and perpetual. Know the difference between the two in terms of the journal entries. And I'm just looking to see here. Yeah, let me just go back to the beginning. Come on, back home. Well, this thing doesn't want to take me home. Okay. But that's pretty much it. Understand the difference between the perpetual world and periodic and that longer income statement. Anybody have any questions on anything? You're okay, Hunter? We'll trap Hunter. How about you, Miguel? You okay? Uh-oh. Just you and me, Teddy.
Oh,
Where's
Hunter's
Hunter?
here.
Is that Hunter? How you doing, Hunter?
I'm doing great. How are you?
Good. So you're okay with this so far?
Yeah.
Okay. Hope it's a lot to learn in such a short period of time. Are you at work by any chance, Hunter?
No, I'm in a room,
Oh, okay.
like a study room.
Oh, okay. Very good. All right. Well, I guess I'll let you guys go then. Okay. You get stuck on the homework, you know how to get a hold of me. I don't mind getting a text or an email. Texting would be faster. Okay.
Thank you, Bob. Just one quick question
Yeah.
is, so I know like a lot of the clothing industries, such as like the Gap, they take inventory check and they also use barcodes similarly to like a grocery store and they keep inventory. Is that like a mix of a perpetual system and a periodical system?
Sort of, but it's mostly perpetual. Even though it's a perpetual system, you would still need to take an inventory once in a while, Teddy.
Okay, got it.
Sometimes the auditors make you do it because they'll say, how do I know your perpetual system is accurate? The one way to check it out is by taking a physical inventory. Okay.
Okay.
Yeah, good question. All right. Well, I guess that wraps it up then. Okay, everybody.
All right. Thank you, Bob.
Thank you.
All right. All right. We'll
Thank
see
you.
Bye.
We'll see you next week. Bye bye.
Thank you. Bye.
Bye bye, Miguel.